Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 33. As always, joined by the three amigos. We got Rich Diaz, Acorn Macro Consulting, looking sexy as ever. And we got Keith Dicker of IceCap Asset Management, of course, everyone's favorite broomer, and a brand new Patagucci jacket. Welcome back to the show, gentlemen. Markets must be good for Keith there. Those Patagucci's aren't cheap. So, I mean, I guess we'll kick things off here. Really with June 1st coming up on the clock, the Bank of Canada rate hike announcement, everybody asking. So we got some of these Twinkies on the line. Keith, I don't know if you got any left after devouring your last box there, but what are we thinking here? Let's kind of start the show off with a bang. Bank of Canada rate hike forecasts. What are we thinking, Rich?
I think they'll do what's expected, which is boring, perhaps. But I'm not ready to I'm not ready to eat a Twinkie just yet. I'm still recovering from my last foray into that depths of sugar and depravity. I think two rate hikes are priced in, right? If I'm not mistaken, guys, just check me on that.
It's 50 basis points.
Yeah. So sorry, 50 basis points. In general, one rate hike is 25 basis points. So I think that they'll do what what's been priced in. I think we're in a situation where what's going on in the markets, and what's going on in the housing sector is being trumped by a desperate, claw for credibility. I mean, I think central bankers, especially in the West, have sort of lost credibility significantly. If you heard Christine Lagarde over the last few weeks, you can understand why.
We're going to touch on the housing sector as well.
But I just think, and so I think now it's not about what's sort of the right, in inverted commas, thing to do with respect to assets or the housing or even inflation, which I know we're not going to talk about it today, but I think is sort of rolling over. But I think it's about, regaining the lost credibility that they have. I think that they'll do the 50 basis points. Sorry, boys.
50 beeps, Keith. You want to take a contrarian bet here?
No, I'm not I might be dumb, but I'm not stupid. This is 50 basis points, guys. It's kind of like I really like American football. That's my sport that I watch, and you have to know when is the opportunity, to really push it hard on something, like whether it's on the defensive side or offensive side. So for all the people out there in the Loonie Hour world, really looking forward to some Twinkies being chowed down. I don't see this as an opportunity to attack a plate of Twinkies at this point in time. Coming up, though, maybe the meeting afterwards. But right now, for example, I suspect they'll do 50 basis points next week. And then the next meeting is July 13th. And that should be that one is in play. As of right now, it's 50 basis points. But maybe that's the one where the Twinkie will come on. And we'll know more about that next week after they come over. But, Rich,
sorry. Can you update?
1 second? Yeah, one second, though. As they say, like when you're playing poker, if you don't know who the patsy is you. And I think right now, Rich, Steve's looking at the table and he doesn't know who the patsy is. So what are you taking, Steve?
Oh, I'm not taking anything here. I'm going 50 basis points too.
Oh,
yeah. The housing shill is calling for 50 basis points.
Right.
I think it's pretty obvious. Like it's already baked in the cake, right? And like inflation, as we've talked about in the show, inflation in Canada is still high. So there's like that political pressure. Housing market is definitely rolling over, but it's still very early days, right? So it's not like it's just way too soon to panic. Like, yeah, there's lots of people up like Schitt's Creek without a paddle in Ontario. that, are stuck with two houses now that they can't sell because they already bought one and the market dumped when they went to sell their own property. So, we're hearing a lot of that, some litigation stories.
I think we'll see more fraud going forward. I mean, I know this is your lane, but I think we're starting to see a little bit of fraud creep up.
Oh, yeah. I mean, I think there's always fraud at the height of a bull market, right? I mean, it's only when the tide goes out, do you see, I think there's a lot of people that, you hear these anecdotal stories where, the market's going up and everyone just looks and says, oh my gosh, like if I don't get on this housing ladder, like how am I going to ever own a house? And so they'll do whatever it takes to get in. And so, yeah, we definitely heard lots, quite a few stories. I wouldn't say it's widespread. There's definitely stories of document fraud and people doing whatever it takes with some shady brokers to get deals done. And those people are probably going to be overstretched, over-levered, heading into a down cycle here. I think we're going to be in a bear market for housing. I mean, the last one was 2 years, and I think this one could be a minimum couple of years. So, Keith?
Steve, I'm a little naive about the whole housing market, and what would some of these, what's the word you use, Rich, to describe what are people doing to make it a bit not nice, or what's happening in the real estate world that I'm not aware of? I don't trade.
Well, I mean, yeah, you hear these stories again. It's not me, so don't look at me. Here comes the
I really have no idea.
RCMP knocking on my door here. I mean, we hear stories, and I've had a couple conversations with mortgage brokers, like, yeah, well, these guys tried to like send me this, and it was clearly fake. So like getting like documented like fake T4s, for example, right? Like, oh, you may earn 100 or fake employment letters, stuff like that, right? So it's really just like trying to boost their basically their income so they can qualify for, the house that they want to purchase, right? So, like Brampton, Ontario is kind of like known as like mortgage fraud capital of Canada, and I think like the equivalent here in BC, and like, yeah, I mean, there's probably some shady stuff going on in like Surrey. If I was to, again, that's not like trying to pinpoint, but it's like we just know, like you just look there and you're like, well, look at the prices, and it's just, anyways. Brampton is known as that. I would say Surrey is like our local BC equivalent of like
what you're saying. But what you're telling me though, it's on the income side. Like, isn't it verified? If I come to you and I tell you I'm making this much money, and I show you a T4 and tax returns, the entity or the issuer of the loan, aren't they making a half an effort to verify?
Let me tell you how the real world works, Keith.
Yeah, I don't know.
Wow. I mean, this is
I'm just naive, right? I don't know. Yeah,
this is part of the problem, is that Canada is like so outdated. Like, okay, government and technology and innovation do not go hand in hand at all. And so it would be very, very simple to tie, your CRA or your T4 incomes into the banking system, right? Like, it should all be looped into one, but it's not. Like, they basically just like, they ask you to send like whatever, a PDF form of your T4, email that to your mortgage broker. So if you got a fake T4, I imagine it's not that hard.
Do you mean, and again,
it's not tied into a central system, so you can't just like go in and check and be like, oh, wait a minute, like CRA says you declared 120K as a house as an income last year, but your T4 that you just sent us says 180. Like, there's not that verification process or system. Is from what I understand, it's not. The systems aren't linked into each other to basically make those proofs.
Hey, Bitcoin fixes that.
Is
that right? Did I use that right?
I think you
did.
did.
It kind of does. Blockchain would probably fix that.
Yeah,
but there's one more thing. I think you're skirting around it. So I'm, in an effort to get us banned from Twitter after they passed Bill C-11, I'm just going to lay it out there. The RCMP does not prioritize white collar crime in this country. I mean, it's very, very, it's very clear. I mean, I've read some of the reports on money laundering. There's one in 2018 that's really interesting. I mean, in Vancouver, they shuttered the financial crimes unit there once they started sniffing around the BC casinos, which I'm sure you know all about, Steve. But like, I mean, I'm not encouraging people to commit white collar crime, but if you're ever going to do it, this is the country. I mean, let's just call a spade, right? I mean, that's just, it's a real shame. I think it's pernicious and nasty. And I think people don't see it as real crime because no one's bloodied. Thank goodness no one.
Because if it's not money laundering, then it's really just someone lying about their income to get.
But it's fraud.
House.
I mean, it's fraud and it's white collar crime.
Correct. But if I'm just lying on my T4 how much money I made so I can get the initial mortgage, and I'm not washing money, like it just this is how much. This is what I have to say to get the mortgage. Eventually, I won't be able to make the payment. Correct. Like 2-3 months, 5 months down the road.
Well, I don't know about that. I mean, I think these people think they can make the payment, or for example, you might have like, I don't know. I'm just throwing this out there. Like maybe you're like a business owner, and your business and you're making a lot of money, but like for tax reasons, you're not declaring like high incomes to the government, which is like strategically a smart tax move. But like the banks will still look at that and say, well, they take your last 2 years of salaried income. So if you're running $1 million business but declaring like a 50K income, well, you basically can't get any credit.
Have you ever heard of real estate transactions where like a bag of cash is used for the transaction?
You're trying to get
I haven't. I think those are just like these fantasies, like tales that the media draws up to get people like fired up. I mean, obviously, I think everybody knows like there's definitely some illicit money in parts of Canada, particularly in Vancouver and some of the higher end luxury stuff. Like a lot of it's done through like blind trust and stuff. I think there's definitely an element of there's a couple probably rogue Chinese Communist Party homeowners here in Vancouver, but yeah, there's not like bags of cash floating around and like widespread mortgage document fraud, but like there definitely is an element of that. And I think that always picks up near the end of the bull cycle. And I don't know, what else can I say? I think the housing market, as we've talked about, continues to slow. I mean, national house prices declined for the first time on a month-over-month basis since April of 2020. So 2 years. So there's like a very marginal 0.6% decline. So not enough to get the Bank of Canada sweating yet. But all I can say is the underlying dynamics, more so in Ontario and definitely in parts of the lower mainland here in Vancouver, sales activity has plummeted. And you're seeing some really aggressive price discounting in the suburbs where all that like excess froth was, where like everybody panicked in at the highs. I'm seeing like detached houses in suburbs. So like Abbotsford, Langley, Mission, like 45 minutes outside of Vancouver, are like 15-20% declines from the highs. Like highs were in February. So it's a pretty aggressive move in 3 months.
Can I just I mean that's crazy. I know our Twinkie bet is kind of sort of a damp squib, given we all sort of agree. So maybe I just wanted to give a little bit of color as far as what other central banks are also doing.
Yeah.
And so internally we track 32 central banks, which I don't know what percentage of GDP this is of global GDP, but it's a lot. So, I mean, US, Canada, ECB, I'm not going to read them all, but I mean, everything from Malaysia, Saudi Arabia, Peru, Latin American countries. And right now we're at 22 of the 32 countries are raising or have raised rates basically in the last, let's say 2 or 3 months, depending. Some of them only raise rates once a quarter, et cetera, et cetera. So, all of Latin America basically is raising rates. Asia, which was sort of slow to the party, because China's cutting. You're starting to see rate rises in Asia. India just did one. Philippines, Taiwan, Malaysia, South Korea has been raising rates for a while. So you're just seeing across the board. Canada's not alone. Canada probably has one of the lowest real interest rates, right, adjusted for inflation out there. But yeah, just to give sort of some color. So one country that's cutting is Russia. Anyway,
yeah, but the second, third largest country in the world economically is cutting rates.
Yeah.
Yeah. I do have just sort of circling back to the whole Vancouver. I was in Vancouver recently, and Yeah. And I was at a coffee shop late one afternoon, and and anyway, at the coffee shop bar where you're having the espresso, anyway, I was chatting with this guy, and he shares with me the story that his friend, she's introducing money from Hong Kong with the Canadian banks. I won't tell you which Canadian bank. She said, yeah, she has a real niche, doing really well with it. And he said she's making $50 to $60 million a year doing this. And I'm looking at the guy. I said, $50 million a year? Is that like the revenue for the bank? He said, no, that's her commission for doing this stuff. And he doesn't know I'm into business, right?
Who are you talking to? Some homeless guy in Vancouver there?
No. And I look at this guy. I said, man, like that's like Tom Brady and Rich Diaz.
Oh, yeah.
They don't make that much money a year. Are you sure about that? Anyway, then he asked me what I did, and I said, well, I kind of do some of this stuff. And he said, well, maybe it's not quite 50 million a year, but the point is though, like it's rampant out there, like you say, Steve. Like it's different.
I think the narrative is rampant out there, because what happens is everyone, like, again, I'm not going to dismiss it and say that it doesn't exist. Our market is heavily influenced by offshore capital. But everybody just looks and says, well, I'm a 9-to-5, I'm a whatever firefighter, and I can't afford a house. So thus there must be gross money laundering, because how is everybody else affording it? And like, there's just so much capital flooding into this market from like all around the world. It's just like the safe haven. It is just ultimately, it really just is a place to park money, right? I mean, like if you're a Chinese citizen and you're like, oh man, look at all these like lockdowns in like Shanghai and Beijing, like really sweet. Like you got a communist government, like you want to get your capital out and have it parked in. I mean, again, you could probably look at it as the same way as like some people invest in Bitcoin. It's like, it's an asset that's outside sort of their system. And it's a safety store of value. And so for a lot of them, it doesn't even make sense for them to rent it out, right? They just want to have money outside. And so there's an element of that. It doesn't necessarily mean it's like money laundering, but I think you just have to understand.
It's a pretty good wash that's going on.
Yeah.
Let's just roll over quickly then, sort of in line with what Rich introduced, more from a bottom up. But I want to talk about the Canadian banks and their earnings.
Well, so I was going to ask you, Keith, before we get into the Canadian banks, can you just up on your screen there, are you able to tell us what the market is pricing in for the rest of the year for the Bank of Canada rate hikes?
Yeah, just 1 second here.
So I think we initially had, what did we have? I think we had 3 to 4 rate hikes at the beginning of the year. So
right now, guys, we're at 1%. We're going to get, the market is telling we'll be at 1.5% in June. And then we'll be at 2% in July, at 2.25% in September, 2.5% for October. And now it's less than 3% at year end. Remember a few weeks ago, I said, hey, the market is now pricing in, 3% for year end. Now it's actually starting to come off a little bit. So everyone who did those Canadian bankers acceptance strategies, now you can send me some more Twinkies, Keith, or something.
Are they pricing in rate cuts yet in 2023?
They have been for the US for a while. I know that. I don't know what it is in Canada, but I know in the US, the further out you go out the yield curve, that's what it's called.
I can only see to the end of 22 on my screen.
You don't have Canada. The Bloomberg Plus premium, eh?
Yeah, I'm not paying $80,000 a year for that option.
Jesus. Need to get some more sponsors in the Loonie Hour here.
Yeah, maybe so. But Rich is making a good point, because now people are starting to anticipate, that'll be a pause. We sort of like, let's just jump over to the Fed now, I guess.
You're talking about the Canadian banks now.
Let's do that first.
Don't cut the people short here.
Yeah. You want to get a bit of a snoozer conversation about bank earnings.
We talked about this briefly last show, by the way, for everyone that was paying attention.
So just to bring it back over. So by the way, before I launched or founded IceCap a few years back, I was one of the responsibilities I had on my desk. I had to cover the global financial sector. So banks, that's what you're looking at. So I became pretty good at moving around balance sheets and income statements and stuff like that for the banks, because nobody else wanted to do it. And I thought it was interesting. But it's only interesting when there's a crisis. Otherwise, it's a bit of a snoozer. But what happens with Canadian banks is very different than, say, oil and gas companies. Well, they can do a bit of it as well, but say technology companies or retail stores, industrial companies and whatever else you want to look at. Canadian banks, they lend out a lot of money. That's where they make most of their money. And when they lend out the money, they know at a certain point in time, someone may not pay them back. So every quarter and every year that they set aside a little bit of their earnings, or it is an expense actually, as a provision for credit losses. That's what they'll call it, or loan loss provisions. That's what we used to call it. Now I think it's PCL. I think they call it now, provision for credit losses. But effectively, they're trying to make a guess on what percentage of their loans will they not get paid back. So it's a very good and easy way for a bank to increase their earnings if they want to, because they can simply just claim less in potential losses on their loans. Or when times are really bad, they'll just throw the whole kitchen sink in there and say, yeah, we expect no one to pay us back, because they won't be, for example, when COVID hit back in, Q1 of 2020, that was a great strategy for the banks because, they weren't going to get blamed for anything. Anyway, what my point is that whenever Canadian banks' earnings come out, it is what you see on BNN, everyone else. Oh yeah, XBC Bank, they reported X billion in earnings. $5 a share. In the estimate was for $1 a share. Canadian banks are awesome, and everyone goes nuts. Yay. So I was very interested in the Canadian banks earnings coming out this week because in my, what we expect to happen, we're going to start to see a slowdown in the economy. So I really wanted to see if the Canadian banks were starting to put aside more money for bad loans coming up, because that's one thing that we would look at to say, okay, because if the banks are starting to provision more for credit losses, then they have a finger on the pulse much greater than we do. So the first thing that came out, so RBC came out today, and so the headline was, they had $3 a share for earnings per share versus the estimate was $2.69. So they crushed the estimates once again. And it's like, holy smokes, man, these guys, they're unbelievable. How do they do it? But then you start reading the fine print. Instead of putting aside more money for bad loans, they actually clawed back $342 million, right? So that's what they're saying. We thought we were going to lose $342 million from a previous period. Now we think things are getting so good, we'll get that money back. Analysts were expecting the bank to set aside $240 million. So you add those two together, you're getting, almost $600 million. And if you adjust that $3 a share earnings that RBC came out with, it really comes down to about $2.58, which is a lot less than what analysts were expecting. So two things here. One of my points is that, don't get too excited about bank earnings when they beat the estimates. That comes out of Bay Street or Wall Street, because it's so easy for these guys to move numbers around and beat it. The second thing that came out, though, was that, so you look at RBC, they're becoming, they're saying, hey, we don't expect to lose much money, going forward, because they set aside, they took money back on their loan portfolio. The same thing, which was it? I think it was TD Bank. They increased their provisioning for loan losses, but they only did it by about 10% of what analysts were expecting. So again, they're setting aside less. So from a bottom-up perspective, the Canadian banks are not ringing the bell saying, hey, we're going to hit a recession. We're really worried about or this or that. In their mind, it's still full on, full go. So either they're not worried about a recession, they're not worried about the bank Canada, deflating a bubble of any kind. But that's something for everyone who's, bullish on the housing market and the economy. The Canadian banks are not signaling today, that they're worried about it. How's that, Rich? I know Rich is an optimist. He's always looking for reason.
I was just going to say
the US.
I was just going to talk about the U.S. banking. So I'm actually much, much more familiar with the U.S. banking sector than the Canadian banking sector. And in the US, you had a huge uptick. I think the US has learned lessons from the great financial crisis that I don't believe Canadian banks have learned. Understatement, perhaps, of the year. But anyways, and in 2008, there was basically no loan provisioning, or in America, what they call it is allowance for loans and lease losses, as what they call it in the US. Every country will have a different name, but it's basically more or less the same thing. And in the US, they did not, as the housing market there was imploding, they were late to basically admit that these loans were never going to be paid back. And so just to give you an idea, the peak in that loan leases was June 2010. And I think house prices had already started to stop falling and recover in some jurisdictions. Whereas but this time around, the US in March, basically, by the summer of 2020, the US banks had already ratcheted up their provisions massively. And you can tell how once you have a crisis, regulators always drive forward looking through their rearview mirror, right? So they're always right. And in this case, it actually worked out really well. So the past crisis really helped US banks in this particular kind of schism. And so the allowance for loans and lease losses shot up right away. And in the US, they're not going up. They're actually starting to come down from extreme high, like from really, really highs. As a percentage of total, they're still pretty high. And then in absolute terms are high. So that's all I want to say. Steve?
Oh, no, I mean, I wouldn't mind, just pivoting a bit here and chatting about sort of, the outlook for markets. So obviously we've talked about, rate hike expectations for the Bank of Canada. Again, I think clearly housing is already rolling over. The Fed released their minutes. I don't know if you guys want to chat about that, but Keith, I think I might have asked you this before, but what's your opinion, maybe your guess, like how doctored, if at all, are these minutes?
You mean
the Fed minutes, right? Because everybody releases
I
and never
know.
goes, oh, they all agree that, inflation too high. Thus we must hike. And I'm reading a piece, today. It says, Ben Bernanke gave a presentation saying 98% of monetary policy is just talk, basically.
So there's so much money at stake all the time. And, so these minutes, they're from a meeting that took place 3 weeks ago. So the opportunity is absolutely available to them if they wanted to send a different message of some kind. The opportunity is there. I've never heard anyone talk in my network that, the minutes are getting rewritten or whatever you want to call it. I haven't even thought of it before.
Massage? Does the verbiage get...
It is sanitized. It is sanitized, surely. I mean, whether
it is, but at the same time,
oh, sorry, go ahead.
Yeah, but at the same time, like most of the Fed members were on the media circuit last week as well. So they always have like many opportunities to sort of, steer the ship in a different direction if they wanted to than the minutes. I haven't thought of that question before, Steve, truthfully. But what I do know though but from the minutes as well as from this Fed member media rounds that they did last week, for the Americans, you should expect 2 meetings in a row with 50 basis points in hikes coming up. This is one hawkish central bank, and it doesn't matter if it's the Canadians or the Swedes or anyone else. Like if the Americans are hawkish and they're walking that way, everyone has to take note of it. So there's nothing dovish about it. People who want to look for a dovish message, they might say, well, maybe they were a little bit less hawkish than what people wanted. And just remind everyone, so in our world, when we say a central bank is hawkish, it means that they're raising interest rates. They're making it more expensive to get money from the system. And if they are dovish, then it means it's easier to get money in this system. And like the point that Rich came out with there a few minutes back about all the central banks that they follow, there's only a few that are actually cutting rates. And again, when you have China cutting rates, they're trying to massage their property bubble, which is breaking, and the Americans are raising rates at the same time. Like this is creating an extraordinary amount of stress on the system. And we may not see it here because, financial markets, we live it in real time, but that's where we're headed. And which I think also we had some geopolitical stuff on top of it, with the little lunches that are taking place in Switzerland this week, I think we need to put that on top.
Well, yeah, no, so good, just to add another point there, because everybody says, oh, people always ask me, messaging me, DMing me and all that stuff. What do you think the Bank of Canada is? What's going to happen with the rates? And it's like, just to reiterate, like Tiff Macklem of the BOC is more or less an irrelevant human being.
Ouch.
It does ultimately come from the Fed. Like the Fed basically is going to dictate Canada's monetary policy, right? So we kind of have to watch the U.S. ultimately. So, guys, this Keith, I guess I was asking you earlier, so the futures market there, forward interest rate, they're projecting rate cuts in 2023 in the U.S. Is that right? Or Rich, maybe that was you saying.
No, I think it's a pause. So right now with the Fed, everyone's expecting 250s coming up, and then go down to 25. Then you're just getting the slowdown in momentum with it. But remember though, with the Canadian banks this week not really ringing the alarm on their loan provisioning, that tells me, like, because remember the Bank of Canada speaks with the Canadian banks every single day. Like there's none of this, they're both in different rooms all the time. I suspect the Bank of Canada, like, they'll continue to be as aggressive as they can be until they're not able to anymore.
Right. So, which comes back to my whole thing, which is like, it's still very early in the housing market correction. Like we've only been correcting for 2.5, 3 months. So, I mean, I certainly wouldn't be panicking as a policymaker, but all I can tell you is the underlying dynamics are deteriorating.
And the banks are not panicking yet. So,
yeah,
I mean, that's what it is.
Rich, we were chatting about a chart there that my buddy Ben Rabideau had put out, but that 85% of over the past, was it 5 years, 85% of Canada's real GDP growth has been derived out of housing and consumption.
Yeah, so I think it's a bit less than that. But I mean, we're splitting hairs a little bit. Also, like, when do you start at the beginning of 2015, et cetera? There's different ways that you can calculate that. But in general, I think Canadians should understand that consumption is the largest chunk of most Western countries or economies' GDP. It's a little bit less for Europe. It's Europe. It's a lot of its exports and that kind of thing, and it's a little bit more for the U.S., where consumption, I think, is like in the high 70s. In Canada, it's sort of in the middle of that, roughly. Well, and then sorry, I was just going to give some context, yeah. And so then how you determine GDP growth can be from investment or capex. It can be government spending, consumption, and then it can be household spending, and then there's a little bit of household investment. And what he was alluding to, which I think is right, is that a huge chunk, sort of a disproportionately large chunk of our GDP has been sort of the gross fixed capital formation, or CapEx, as it's otherwise known, of specifically residential. Now, that's really shocking. It also is an indictment on our overall investment. So when you say that, because the other side of that coin is that the investment in other let's say structures and equipment, or intellectual property equipment, computers or software or research and development, all that stuff is getting basically crowded out because you're effectively only investing in residential capex. So you had the situation where most of the growth came from two things, which was consumption, Canadian household consumption, mostly debt driven, and residential capex. So yeah, that's the point he was making, and whether it was 75 or 85 or whatever, the point I think he was really trying to make, and I think you're making, is that it's huge, it's unsustainable, it's dangerous, it's not strictly productive, and eventually sort of the tide goes out, and that's sort of where we're in the situation we're in now.
Yeah, no, so I'd like to just kind of touch on that point, expand a bit further, because I think that the central bankers, I feel like, are right in the fact that, like, okay, well, if you're going to sort of try to bring down inflation, let's hit consumers where it hurts most, which is, the wealth effect, right? So, if so much of this, for example, in Canada, is built on consumer spending, consumption, Well, again, guess what? If your house in the suburbs there in Brampton, Ontario goes down by 20%, all of a sudden you're like, well, maybe I won't get the big new flat screen TV. And I think, like, again, maybe early days, but are we not seeing this in some of these big ticker names reporting over the last week? Was it like Target reporting like excess inventories, Walmart, I mean, Amazon, I think is talking about what a hiring pause, or was it laying off 100,000 people, something along those lines. We were also seeing today here that the trucking spot rates reached a new cycle low yesterday. So, basically trucker shipping prices are coming off. So Rich, I don't know, is there any sort of data you're looking at right now that is pointing towards sort of like this economic slowdown clearly in process, that inflation expectations are maybe coming off? I think the equity market is clearly telling us in these retailers that.
Yeah, you stole my punchline. So, I mean, and it's a really good point by you. So in general, I think everyone should understand that most economic data is lagging. So it's lagging for two reasons. One, it literally takes time for these processes to feed through to people and then through to surveys. And it's also lagging for a second reason, which is it just takes time to collate to the data. It takes time to ask the 4,000 managers in the ISM PMI. And then it, so for example, we'll get our April employment data at the end of May, right? So, and so that's really important. And so there are some economic indicators that are leading, but even that's a bit tenuous, and it doesn't know, and the correlations lag, and it doesn't lead by 3 months or 6 months. And then sometimes it doesn't lead at all. And so in general, my life is always sort of, trapped looking at backward looking data in a sense. GDP is probably, the most egregious example of that. Germany's GDP for Q1 came out and it was plus 3.4 or whatever. It's already almost the end of Q2, right? So just to give listeners sort of some context. So you asked me, what do I look at? And then you sort of, you stole my punchline, which is a really good point by you. I like to look at equity markets and credit markets as sort of little tiny indicators. Again, it's not foolproof, but indicator that the equity market will sniff out what's going on in the economy. Not all the time, but a lot of the time, long before you sort of get that. Just as an example, the other day you tweeted a chart on Home Capital Group, the equity group, or whatever. I can't remember the names now.
Equitable Group. Yeah.
And then there's a Go Sleep or Sleep County or whatever it is, right?
Go Easy Lending.
Right. And so I see this all over the place, right? So whether it's political, changes, things that's going on in politics. So you'll see like, a defense company will start outperforming, or, before we got this recent sell-off in growth, consumer staples were starting to outperform. What does outperform mean? It means the index is doing better than the overall, right? So what I try to do is I have many, many, many charts of what I call equity market bellwethers. And I use them. Again, you can't swear by them. It's not always perfect. And there are some false signals for sure, but it's something I look at basically religiously. So for every theme, whether it's energy, whether it's housing, whether it's, luxury goods, whether it's, green energy policy, all these different themes, or robotics, or the theme, you try to think of the 5-6 stocks or equity, 5-6 stocks that sort of are at the cutting edge of whatever theme. And then you plot those, you take really, really close attention. And then you see when there's inflection points, changes in trend. Are they outperforming or underperforming the other equity market more broadly? And, that's one of the reasons I love financial markets. There's information in the price. Ultimately, that's what I'm getting at. And I'll pass it over to Keith. I'm sure he has his view too. The same is also true in credit markets. Again, we don't speak enough about credit markets here. It's something we should probably try to improve. But you could see there was, we talked about it several weeks ago, credit spreads, right? The amount of compensation you need to give lenders over the, let's say, risk-free rate is starting to ratchet up higher and higher. And we haven't seen a real financial accident yet, but spreads are starting to widen long before foreclosures tick up, delinquencies tick up, consumer confidence ticks down, long before you have people like the Volkswagen Financial Group say, people are not paying back their car loans quick enough, et cetera, et cetera. So it's just something that, is a really good point to bring up. It's a great topic to discuss with people who aren't necessarily familiar with these kinds of things. But I like to look at this all the time. I call them bellwethers, and I have them for all different kinds of sectors.
Keith, you got any commentary on top of that?
I forget the question, truthfully.
Classic.
What was the question? I don't remember.
Through Rich's rambling. No, Rich, it was a good segment there. Basically, just looking at some of this, what equity markets are basically telling us, like anything in particular that you're looking at, which is like, basically we're seeing the stockpiling of inventories at some of these massive retailers across the US, which is sort of signaling, I think, consumption is slowing. That they might have over stockpile, overbought, and I think that's what we're now seeing. Obviously, shipping or freight rates coming off as well. So maybe this is the early signs of inflation at least peaking and beginning to roll over. Now, again, it'll probably still remain elevated due to the global shortage of commodities, but I think we've probably seen close to the highs in consumer-led inflation.
I mean, it's a really good point. I know we've talked about it before in that the real economy and financial markets, they're never in sync. So that's why, like, frequently you might see some models where, they'll take overlay, say, the stock market over another data point, but they'll take like 6 months moving forward or 6 months lagging or something to that effect. And that's how you can forecast where things are going. In our mind, we think there's a pretty high probability that economic growth, it is slowing, it's going to slow, depending on where you are in the world, whether we hit a recession or we go down pretty dramatically with growth in Q3 or Q4 this year or Q1. That's where we're headed. I mean, that's where we're going to go. That doesn't mean equity markets continue to go down from today into that period. Maybe with equities, maybe we find a trough here over the next few months, and then they can start taking off again, which will really sort of reconcile with central banks stop hiking rates and things like that. If you think of it for that. Do you see that as a
bear market rally coming, or do you think we've got one more big puke to come, kind of thing? I mean, crypto seem to be leading the way again. Another big dumping is recording here today.
Yeah, I don't know if puking is the word to use. I still don't think we have all the excess taken out of. For example, a lot of the losses in equity markets so far, that they've really been taking place with companies that they just weren't profitable. You want to call them the unicorns, or like a lot of these companies in the tech space that had spillovers into other markets. Those are the ones, like, they're down like 60 to 80%, right? Those guys are gone. Meanwhile, headline markets are probably down, I'm guessing, 20%, maybe something like that. So headline numbers can come down a bit more. Our primary equity models, they're suggesting to us that we're still in this, downward trend. It's nothing to alarm us that, we're going to have this puke, that the word that you just used, like we're down 10, 20% quickly. We don't see that, but we're in for a bit of a grind here coming up. And the big thing is, like I said, if we do start to, I think we're headed lower economically. That's where we're going to go. It's going to have a lot of knock-on effects from that. And people just need to prepare for it. And unfortunately, or fortunately, depending on which way you want to react to it, inflation is going to stay sticky. It really is. And so for your investment portfolios, there are ways to make money from that, and there are ways to reduce or minimize potential losses that are coming up.
I mean, I think there's no question. I think over the next 12 to 18 months, and these are going to be very challenging times for a lot of people, unfortunately. And just to kind of touch on the way that government is handling this, policymakers are opting to handle this, is kind of really what we predicted. Again, right or wrong, it seems to be that they're going to point the finger at the large corporations for, price gouging people, and looking at, various taxes on corporations, like price controls are coming. And, we've now got more stimulus and helicopter money for low income families. So we had New Zealand coming out, and I think they were saying they were going to give every household like $27 a week to sort of offset the cost of living crisis, is what they're calling it. We just had the UK, as of today, with the day that we're recording this, coming out with a 25% surcharge or tax on oil and gas companies, because they are claiming that oil and gas companies are basically price gouging. And so I mean, it's kind of leading to a very precarious situation, because we've got this World Economic Forum ongoing at the same time, and it's like, well, guys, like, everybody's governments are largely to blame for the current situation of commodity markets, right? I mean, governments told every oil and gas company to stop drilling and exploring for new supply because it was not good for the environment. And then now you've got this like shockingly, now you have a shortage. And so now you're going to tax them because they're price gouging. But Rich, I don't know if you want to chat on oil and gas and anything like that, because I think the one thing that kind of irks me, and I'm sure it's not people that are listening to this podcast, because I think that people that are listening to this are probably pretty well educated, but when I see, like, for example, like, what's that?
Probably.
I mean,
maybe, or maybe not.
Based on the 200 people that came to the live event, they're all quite smart people, so we like them very much. But I always see, like, people are upset right now. There's a lot of angst. There's inflation. Wages aren't keeping up, and so the average voter, which I think is unfortunately not that sophisticated, when governments are coming out, they're saying, oh, the instant reply, if you go on Twitter, like any government that's talking about like rising fuel prices, the instant reply is, oh, these oil and gas companies are price gouging, like we needed to tax them. And it's like, people don't realize that the price is set by the markets. And then obviously governments have an influence on the tax. So Rich, I don't know if you want to unpack that. I'm probably setting you up here for a big rant, but
am I that obvious?
Maybe keep this relatively calm and sophisticated here, but just give the listeners kind of a walkthrough.
Sure. I mean,
I think a nap, guys. Hours.
So there's a couple of things to unpack there. One is, I think governments are always, I think they're always like looking, they're a lagging indicator. And I think that's really something that I will probably go to the grave believing. Politicians don't lead, they follow. Very few times in history do you get a politician that actually leads. Right now, I think we're sort of bereft of that. And I think that on the inflation thing and on the corporate profit, on the corporate margin and the corporate profit thing, I think that's exactly what's going on. I think margins are going to come off. Margins are already at their all-time highs. And I think that, that's whether you look at the S&P 500 or in Canada, or whatever it is. And I think that that's going to come down because the wage growth is snapping higher. All the input costs are going higher. And so, instead of trying to mitigate and deal with the fact that a lot of these countries are going to deal with less revenue, not more going forward, they're doing, in my view, the exact sort of wrong thing. I think the other thing is, by sort of blaming corporations for inflation, by blaming Russia and by blaming that, it sort of absolves themselves from what we heard just a year ago, which is the build back better. It's this idea that you can have unlimited deficits with no pain. We'll get to more pain, and we'll get to pain in the gasoline sector in a second. But I mean, that's really what we've experienced, right? We've experienced sort of an incredible, unprecedented increase in liquidity paired with, budget deficits that were 2x and in some cases 3x what we saw in 2008. Again, with the lockdowns, which screwed the supply. I don't want to relitigate, what I think is terrible COVID policy. But my point is, this was a crisis that was manufactured by the people who are now telling you that they're going to be able to fix it by handing handouts. And so, it's for me, it's really frustrating because It's quite circular to the point of it's sort of nauseating how circular it is. But the thing, and then just to finish up on oil is like, CapEx. I mean, there was a tweet from 2017 that I saw that someone put out. It was Emmanuel Macron bragging about the fact that France has basically banned all oil exploration for the next, and by 2040, all oil exploration in France will be banned. Now, France has a lot of nuclear energy, so maybe they can get away with that. But that is the hymn sheet by which every major politician was basically singing by. And what we have seen with the invasion of Ukraine and obviously, the fallout from COVID is that the energy transition to green energy is causing shortages, and it has caused inflation pressures. And the pain, and there was no pain necessarily baked into that. All of this policy was sold to people that it would be painless, easy, cheap, wonderful, the best thing ever, great for your kids, great for your wife, great for everybody. And what we're seeing now is how much of a lie that is. One thing that's really important, sort of from a technical standpoint, I'll pass to Keith rather, is that the reason diesel prices, for example, and gasoline prices have gone up is because of something called a crack spread. Now, crack spread basically is the difference between how much it costs for a barrel of unrefined crude oil versus the price that you sell at the pump. And the reason that there's a basically historically large crack spread, the reason they use the word crack is because that's what it's called when you're refining oil. You crack it, you crack the hydrocarbons, right? You've got different hydrocarbons. The longer the hydrocarbon, I believe, the more dense the fuel, and the shorter the hydrocarbons, the less dense the fuel, right? And so that's how you distill alcohol. And it's the same ways that's you refine oil. At the bottom, you've got tar, and at the top, you've got kerosene and gasoline for a high performance car. And so crack spread, it basically tells you the dislocation between the unrefined oil and the refined oil. Anyways, all this to say, they've been not allowing, jurisdictions have basically said you're not allowed to build any more refineries anywhere. They've been mothballing refineries. What I'm saying to you is this is the kind of painfully obvious fallout from bad, short-sighted energy policy. And so this idea, and so now it's like, it's really rich, it's really stupid. And I would behoove all of our listeners and anybody that we're listening to just like push back on that. Capital expenditure as a percentage of total assets for all of the global oil companies is at a 25-year low. And that the reason is because of places like CalPERS, which is the California Teachers Pension Fund, and the pension plan in Quebec have divested. They have starved these companies of capital. They've told these companies they're not allowed to invest in capacity, and demand is not going down. And so you have a situation where you're not allowed to build any of the capacity you need into the system, but the demand for the product continues to rise because oil is super useful, as you guys know that I've gone on and on about this. And so you have the situation where it's anyone who was sort of paying attention, it was rather obvious. So the big lie now is that these corporations, these oil companies, are gouging people. But the truth is, commodities are a shit business. And the reason they're a shit business is because as soon as prices go up, people spend money to capital expenditure to eke out that extra marginal dollar. But for the first time in history, we've not allowed. And so just, when you read these headlines, it's important to just take a second and go, what did that, talkative guy, Rich, who didn't know when to be quiet, say to me? Oh yeah, that's right. This is a purely self-inflicted wound. This is an own goal. Oil's not going anywhere, and there's no capacity to alleviate the price pressures. There's my rant, boys.
I really enjoyed that, Rich. I really, okay. I really knew, I knew all of this myself, of course, but of course. But the explanation of the crack spread and how it works, I think a lot of people will find that incredibly useful. From our perspective, as money managers, we tend not to take to show our opinion on what should happen and what shouldn't happen. Instead, it's incredibly useful for your savings and your investments to know who's making the decisions and have they changed their mind on stuff. So Rich, what you just described was a outstanding foundation. So then as an investment manager and investors, everyone listening, you want to see, is there any evidence out there that the world leaders are changing that view? And fortunately, we get a pretty good perspective on this from what's happening in Switzerland this week at the World Economic Forum. If people are not familiar with that, with the group, do your own back search history on it and you'll discover what it is and what it isn't. But let's talk about I want to talk about some of the main themes that are being discussed there this week. And this helps us for managing portfolios. And again, it's irrelevant to what our view is on anything. Instead, you always want to know, what are the policymakers thinking? So I think first we'll start off with the whole concept of climate change. And the world leaders over in Switzerland. Oh, by the way, it's Canada is very well represented at the World Economic Forum. Boy, you can go on and on. Who's a member of that group? Mark Carney is there, front and center, of course. Our prime minister, he's been within that group for a number of years. Same with the leader of the NDP party, our Minister of Finance, Chrystia Freeland. She's also there. One of the biggest influencers behind the scenes for Canadian politics, Gerald Butts, he is front and center over in Davos as well. And so for that reason, we know that whatever policies are discussed and presented and everyone agrees to in Switzerland, they are going to come here into Canada. And what Rich just described with, demand will continue for oil products. Meanwhile, supply, the ability to get it, that's being strangled. That is not going to open up anytime soon. So the whole concept of if you want to make money or not lose as much money as you might elsewhere in the whole energy field, from my perspective, what I'm hearing in Switzerland this week, like it's incredibly bullish for that story. Does that make sense with you guys as well?
Yeah, it does totally. Can I just quickly add on, like one of the CEO of Norway's largest bank, which is a very rich lady and powerful lady, said the energy transition will cause energy shortages and inflation pressures. But the pain, quote unquote, will be worth it. I mean, stuff like that, Keith. I don't know if you want to add to that.
I think we should just clarify, because I think people here in Canada that are listening to this, we have it pretty good, right? I mean, we're commodity
that's
rich.
exactly right.
When she comes out and says that, like, we're not like, okay, we'll be impacted, we'll suck, you'll pay more at the pump, et cetera, heat your home. You're talking about like people dying.
Right. It's third world countries. It's India's, it's the Sri Lankas of the world. It's the people who don't have the largest oil reserves in the world. Canada will be fine. Fuck.
Yeah, like exactly. It's these countries that have to, import, all these commodities essentially that are really going to be paying the price, and there will be famine and death and it's unfortunate and
Keith, so what are the other topics that they were talking that you want to cover?
Yeah, so the other one that really caught my attention, of course, is everyone's focused on the Ukraine-Russian war right now, and so again, you're always looking for pivot points. Like, what's going to happen here? Is it the change? Will it swing the other direction? There was only one person over there, or I've heard, over the last week, who's even suggesting that there needs to be a solution here. Let's just end this the way it is right now. And that's Henry Kissinger. And he was booed off the stage. He's basically been called a, Russian stooge or a commie for even suggesting that, they come to terms with the Russians. And the reason this is important to know is because all the main policymakers out there, led by the Americans, they want war. They're moving towards that. They are not backing down whatsoever. So from an economic and geopolitical and financial perspective, the probability of things escalating even further, it continues. It's there. Turkey is getting involved by blocking both Finland and Sweden from not being able to join NATO. There's lots of stuff happening behind the scenes, and then on the other side, of course, we just saw the American president, announce to the Chinese that, yeah, sure, they'll definitely walk in and protect Taiwan, absolutely. To which afterwards, the White House press secretary had to remind everyone that no, he just misspoke. He didn't mean to say that. But again, the point is that the world right now, it is being heavily influenced by a very large sector that profits from a war machine. To give you another example, the Americans have very quickly approved about $60 billion to go to Ukraine to help them on the war effort. And if there's been a few people in Congress and Senate that said, hey, wait, that's a lot of money. We need at least to audit this or to figure out where the money is going. And again, if you're even suggesting that, you're branded to be, a Putin puppet and things like that, no questions asked, 60 billion gone. To put that in perspective, because people get numbed by these big numbers all the time. During the last, with the last American president, he wanted $5 billion to improve the wall down on the southern border. And that was deemed to be too much money. That could not be considered for anything, $5 billion. And there's a lot of studies out there that show that just doing that wall would have had a savings of anywhere from 50 billion up to 200 billion and different kinds of direct and indirect savings, for the country. And no, squash, 5 billion, no deal. $60 billion being put on a crate with missiles and weapons overseas, no problem, no questions asked. But that's my point. Now that we know that's where the governments are headed and there's no turning back, it is likely going to create more conflict coming up, which could create even more higher stress points, I guess, or pressure points on the inflation side for both, oil, energy, as well as agricultural commodities. So you want that kind of stuff impact your portfolios.
I just want to add, so I just want to say something. Like sometimes when you say profit, I think, people have a narrow view of what profit means, and I'm obviously guilty of that. But I think it's also about sort of politically profit. And when there's profits, there's also losses. So, for example, our government and many of the Western governments have sort of committed lots of political capital to fighting climate change in a very narrow way. Renewable energies or bust. No nuclear, no natural gas, transition to natural gas, nothing. And so and this is what I think, this is the way I sort of perceive that, this idea that they want to profit from it. Because if they walk back, for example, something we talked about before we got on was of the majority of the price that you pay at the pump is taxes. And if they were really, really worried about, working class people paying an increasing amount of their disposable income at the pump, they could just cut those taxes and it would alleviate a significant amount of pressure for the people who are most vulnerable and most likely to benefit. Similarly, if they just changed, for example, the carbon tax, or if they said, you know what, you're right, we screwed up, we need to increase supply of the world's most important commodity, they wouldn't profit from that kind of policy. As good as it is for humanity, they would lose. And I think that's for me the way I see it. I mean, there's just been so much political capital invested in this singular worldview, and any deviation from that is perceived as weakness, and they are going to be discredited. I don't know, I know that's a bit of a tangential view of that. Maybe it's too generous of you, but I think that's an important thing when you consider these doubling down on renewable energies in Germany, doubling down on carbon taxes in Canada. I think it's important to remember that people have committed to this. win, lose, or draw. They don't care what the right answer is. It's so it seems to me. I don't know, Steve, if you have.
Oh, no, I think that's a good way to wrap it up is basically, I think it's north of, so in BC, I think we have the highest gas prices in Canada. I think we're now, I think a liter of gas was at $2.25 a liter a week ago. Anyways, I think about north of 60 cents. I think it's about 60 to 70 cents a liter. It's apparently just straight taxes. So keep that in mind next time you go to the pump. Funny enough, and I just don't think it's going to be solved. Everyone just says, well, EVs. I mean, good luck trying to get all the commodities mined, to support all these electric vehicles. What's funny is city of Vancouver, where I live, God bless, is they've kind of branded themselves as the greenest city in the world. That's kind of like the mantra they're going for. So we're at the forefront of all these, like, I think, borderline insane policies. But one of the ones on their website is they've got this climate emergency action plan. It says by 2030, 50% of the kilometers driven on Vancouver roads will be by zero emission vehicles. Not gonna make it, is how I'll say. Let's wrap it up there. It's never gonna happen. But people, I guess, believe in it or want to believe in it because nobody's really sat down and done the research and figured out that it sounds nice. It's just not economically viable. But anyways, we'll wrap it up there. As always, we appreciate your guys' support. Hopefully we didn't offend too many people there and lose too many listeners. But again, guys, this is not about our political views or leanings or how we wish markets or governments would act. It's simply how it is. And we're trying to basically cut through the noise. And that's it. So all we ask is that you share this episode with one friend, continue to build the Loonie Hour community, and we'll see you next week.